So today I'm going to talk to you a little bit about the difference between your sheriff's sale list and the trustee list. So they're both foreclosures. So one, the trustee list is mostly mortgage foreclosures, and the tax list, or the sheriff's list, is mostly tax foreclosures. HOA foreclosures in Texas can fall under either one, depending on how the HOA wants to file it. One is done by a trustee, which is usually an attorney or attorney-looking person with a manila envelope that goes to the auction, starts reading it out. And one is done by the sheriff, somebody with a gun and a badge. Now, if your property is read out loud at the trustee sale and nobody bids on it, then it's going to go back to the bank, right? Because the bank is then the highest bidder. If it gets read out loud at the sheriff's sale and nobody bids on it, then it's going to go to the county, and it's going to be owned by all the different taxing jurisdictions that were a party to that. If someone does bid on it, then that person becomes the new owner of the property. And say, for example, with the trustee sale, they weren't in first position, that lien. So there'll still be another lien on top of that that they would need to be responsible for. Or if there's taxes owed, they'd be responsible for those taxes. Say, for example, they win at the tax auction. Here in Texas, there is a right of redemption. If it's agricultural homestead exemption, then it's a 2-year right of redemption. And if it's not, then it's a 6-month right of redemption, where the previous owner or anyone who had interest in the property, meaning a lien holder or anything like that, could come back and buy the property back from you for what you paid for it, plus any reasonable expenses you had to maintain the property and keep it in decent working condition, and securing it and things like that, and keeping the taxes current, keeping the grass mowed, anything you had to do. Now, if you didn't have to put in granite countertops, they won't give you the money for that. So they'll give you back any money you paid, plus anything you had to do to keep the property secured and in good working condition and safe. And, you know, just like if you had to board up the windows, keep the taxes current, if you had to fix a leak or something like that, just keep all those receipts. They'll give you that plus 25% interest for the first year, and if they do redeem it in the second year, it's 50% interest. If they don't redeem it at all and you pass that time, then you should probably, at that point, you could go to a title company and make sure that you're okay, and you can put it on the market to sell it, or start rehabbing it yourself, as long as you have title insurance showing that, you know, you're the owner. So these are the main difference between the tax foreclosure and the mortgage foreclosure, also known as the sheriff's sale, tax foreclosure, and the trustee sale, or the mortgage foreclosure. Follow my channel if you have more questions about real estate news. There's other types of loans too that are super rare, like timeshare liens get done sometimes at the mortgage foreclosure auction. Tax liens sometimes get done at the mortgage foreclosure auctions. Sometimes Habitat for Humanity will sell properties, but you have to like qualify to be the new owner of it, which means that you have to make like less than $50,000 a year, or whatever the restrictions are in that area. So before you win the property at the auction, you have to prove that you know, your last tax statement that you can bid on it, which is confusing because you have to have the cash to buy it, which is say $130,000. So how can you have $130,000 cash at the auction and also make less than whatever it is, $50,000 a year? I mean, I guess there is some people that can do that, but it's super complicated. Most of them are going to be straight down the line. Follow my channel for more real estate news. Thanks.